Hello, my name is Kaylin Bennett, and I am a fellow real estate investor. But more importantly, I'm the producer of the Real Wealth Show. Kathy unfortunately had some technical issues recording this intro today, so I'll be covering that for her. On today's episode, we are talking everything under the sun about mortgage rates, lending trends, and what investors should expect in 2025. So, welcome to the Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
On today's episode, we're bringing on one of my very favorite data analysts and journalists in the real estate space. His name is Lance Lambert. You may have seen him analyzing data at Realtor.com or as a real estate-focused journalist at Fortune Magazine and Bloomberg. He is now the founder of Resi Club, which is a website that translates data about the housing market into accessible journalistic articles for industry professionals, real estate investors, and the average person. I wanted to bring Lance on the show today because he does an absolutely incredible job at making really heady and hard real estate topics easy to understand for the average everyday investor like myself. So on today's episode, we are going to be diving deep into the mortgage industry and housing market trends. We'll discuss everything from the lock-in effect to what the heck marry the house, date the rate means and how it has impacted buyers. We'll talk switching costs. We'll talk overall market trends. And we'll round it all up with lending trends and what investors should be looking at this coming year. All right, without further ado, let's bring on Kathy Fettke and Lance Lambert.
Thank you for having me. Housing. Always so much going on in the housing market.
It never gets old, doesn't it? I've been doing this 20 years. You'd think I'd be bored, but it's never boring.
Exactly. Yeah. There's always just so much going on and so many different trends. And the big thing of housing is it just affects everyone in some way. Even the people, of course, there's the people who are, lifers in the industry, but also, everyone lives somewhere, right?
Yeah. Maybe that's why I care so much, because it really does. It affects everyone. And I appreciate that. So what I would love to hear about your journey as a journalist. I started my career as a journalist as well. I'd love to hear about yours.
Yeah. So, going way back, I had studied, I was an economics major in school and then also journalism. So I kind of knew I wanted to be a financial journalist. Had worked at places like the Cincinnati Enquirer, covering business news, Chronicle of Higher Education in DC, Dayton Daily News. So I did a little bit of the daily newspaper grind. And then after a while, I found myself at Bloomberg. I was a data journalist there and had kind of decided, you know what, I'm ready to leave journalism. I want to go a different direction. I wanted to become a data scientist. And so I went that direction and I took a bridge job at News Corp's Realtor.com, where I was analyzing a lot of housing data, but then also it was kind of a little bit hybrid where I was still doing, some visual storytelling, but really deep in the data as well. And at some point I decided, you know what, although I think I would be a great data scientist, I kind of like this in between of a good amount of, storytelling, but then also deep in the data. I launched Resi Club, and Resi Club is a news and research outlet that covers the U.S. housing market. And it's really just things that I enjoy covering and reporting on, and just the way that I enjoy covering and reporting, which is very data driven. And I think people who read our content will see that it's very visual, lots of maps, lots of charts. We don't take the housing market as one size fits all. We know there's a lot of nuance, a lot of regional variation. And then we also try to help to connect the dots, because it is a very confusing time, right? You have parts of the housing sector, like the mortgage industry, that's going through one of its deepest bust really ever for the mortgage industry. Because historically speaking, whenever the mortgage industry has lost the purchase side of the market, they've usually seen a bounce up in the refi side of the market, right? And that's what happened in GFC, is purchase tanked, but you ended up getting some activity, a good amount of activity refi. In this current environment, refis in the dumps. Nobody's refining, right? So many people, or there are some people refining, but there's very few of it, right? So many people with the 2, 3%, 4% mortgage rates, and in the 6, 7% market, traditional refis just gone, right? And
Yeah.
then the purchase side of the market, we just found out today that existing home sales in 2024 are at multi-decade lows, the lowest since 1995. 4.1 million existing home sales compared to, we were kind of around that 5.3 million back pre-pandemic, like 2019, 2018, 2017. And so you have 1.2 million existing home sales that just aren't occurring, right? And so you have a
Yeah.
lot of like the regional variation, or you have a lot of industry variation, right? And then you have other parts like, single family home building. And while single family home building, maybe some pockets of Texas and Florida are having to, increase incentives to continue to move product, it's nowhere near in the dumps like you're seeing a mortgage, right? And so I think just kind of a lot of that, and just being able to explain that in a way that really makes sense to people.
I absolutely know what you mean about the mortgage industry. I was in mortgages in 2005 up to 2008, and then for me, I was done with it. I'm impressed with anyone who stuck through it after after that difficult time. And the same for today. It's been a lot of people feel like we're in a recession, and it's because there are certain industries that are in recession. And like you said, mortgages are one of those. Okay, so let's dig in. Since we're talking about mortgages, let's talk about rates. We are seeing record low home sales, as you said, and that has probably everything to do with the high rates that we're seeing today. So what's going on?
Yeah. So the reason that existing home sales are so suppressed is exactly what you said there, which is we have very high switching cost in the housing market right now. And switching cost is a great word to familiarize yourself with for economics. And there's both the financial side of switching cost, and there's also the psychological side of switching cost. And so switching cost got dramatically higher for homeowners who wanted to sell and buy something else when rates spiked in 2022. And the reason is the financial side of it, their monthly payment for a lot of them would more than double, right? Going from that 3% mortgage rate or 2 or 4 up to a 6 or 7% rate. It's just a really big financial hit on that monthly payment. So the switching costs got really high. Now, I think long term, we could start to see a grind out of this, slowly start to work our way up, because the switching cost on the financial side have not continued to deteriorate that much, right? Yes, prices in some markets are still moving up, but rates haven't spiked further, right? And prices aren't moving up like they were before. And so a lot of people in this current environment, if your income, you can get your income to rise, you can kind of start to bring down that switching cost a bit. And the other part of it is the psychological into switching cost, which is, let's say you have a house that's 2 or 3 bedrooms, right? And then you have 2 or 3 kids, and you're starting to get more people into the house, right? And less space. And that can start to be a hit to the psychological cost of switching cost, because maybe your wife's starting to get unhappy. She wants more space. She wants to go to a different school district. And so over time, the switching costs can come down a bit, and you start to see the existing home sales begin to work up. This exact same thing happened in the early 80s when mortgage rates shot up to 18%. Existing home sales crashed, right? Went from 4 to 2 million. And over time, as the switching costs slowly started to come down, and then they also got helped because rates started to come down as well off of the highs, the switching costs went down and you started to see some churn back into the existing market. But it was a grind back. So after we fell off the peak of existing home sales in 1978, it took about 13 years to get back to that level because switching costs just got so high and it was such a grind back. But to answer your question about mortgage rates, is we're in an interesting environment where, yes, the Federal Reserve has entered into the rate cutting cycle that they started last year, and we'll see, if there's pauses or what happens there. But unlike many of the former rate cutting cycles, is that as of right now, the labor market still hasn't cracked, right? where the economy is still growing. And so while former rate cutting cycles have seen a drop in mortgage rates and long-term yields, we're not seeing as much of it right now because long-term yields and long-term and mortgage rates, they are based not just on where the short-term Federal Reserve rate is at, they're also based on the expectation for where the economy, those future monetary policy, future inflation, and the future labor market are going, right? And so even though we've seen some cuts from the Fed, we haven't seen a deterioration in the broader economic outlook that would suggest more significant rate cutting in the future and a lower rate environment. And so that's why we've seen the long end of the curve with these, like the 10-year treasury yield, the 30-year fixed mortgage rate being higher than what the industry had hoped for.
How did so many people get that wrong? I mean, there were major economists and companies who thought rates would stay low for forever or for a long time.
Yeah, well, so so economic forecasting has never been easy,
It's
right?
never easy.
Uh,
Yeah.
and then it gets even more challenging when you have unprecedented events like the COVID-19 lockdown,
Yes. Hmm.
extraordinary levels of fiscal and monetary intervention, and then all of that followed by an inflationary shock and the fastest rate hiking cycle in 4 decades, right? Just adding more complexity. And so 2024, if I'm remembering right, 22, 23, 24, last year was the third year in a row where almost all the forecasters were too low, right?
Hmm.
They thought mortgage rates would come in much more than they did, and
Oh
they did.
yeah, Wall Street thought so. I mean, it's been.
And so right now we could be set up for something similar. I track 17 different mortgage rate forecasts, and the average of all 17 of those expects that the 30-year fixed mortgage rate by the end of this year would be 6.33%. So
Hmm.
3. And right now, the I didn't see what the Freddie Mac one came out uh, today yesterday, but Mortgage News Daily is at 7.11%. So we're like, what, 80 basis points over what the average forecast expects us to be by the end of the year.
Yeah.
And, and I think if,
And it's just not, it's just in this environment, it doesn't make sense to me. I just keep arguing with economists about this because it's like we're on the Trump train, right? This is a growing economy, most likely. This is a lot of bond investors are expecting there to be growth in the next 4 years. So how do you see mortgage rates go, not you specifically, but how do people think that we'd get to 6.3% under those circumstances?
I think the reason a lot of them had been wrong is they expected greater weakening in the labor market.
True, from all the interest rate hikes. Makes
And
sense.
we
Yeah.
haven't seen it as much, right?
Yep.
And part of that is because of housing, residential construction, despite everything that's gone on in this environment, it stayed way more resilient than expected. So
Hmm.
that's part of it. Uh, and then, so I think for us to roll off of these highs for mortgage rates, I think the biggest thing you would need to see is a deterioration more so in the labor market that we just haven't seen to this point. And like you said earlier, Kathy, there are areas of the economy like mortgage that have weakened and are kind of passing through recessions, but not enough to cause a broad based weakening in the labor market. And so until that happens, I think we're kind of in this kind of higher for longer environment.
Yeah. Okay. So, with that, there's been a saying, at least last year, marry the house, date the rate. What does that mean? And does it even work anymore?
Yeah. And so the idea there is, and this is not something that I've ever pushed, and I've written
Yeah.
stories. When I launched Resi Club, one of the first stories I wrote was 4 thoughts on marry the house, date the rate. And the idea of it is that you buy the house that you want. And if you get the house that you want and you have it, then if the rate environment shifts, you have the opportunity to refi down, right? I think the thing that I have said, and I have a story titled 4 Thoughts on Marry the House, Date the Rate from 2023. The first one, my thoughts is no one can predict mortgage rates with 100% certainty, right? Uh,
Right.
there's no shortage of forecast models for both house prices and mortgage rates. And there's no shortage of forecast for house prices and mortgage rates that have gotten it wrong, right? And so past outcomes do not guarantee future events. And so there is uncertainty with rates, right? Now, to give a little credit to that crowd that pushed it, because I don't want to bash them too much, is that while like 2022 home buyers have not experienced the refi relief that they had hoped for, most of them that had bought that year actually have a lower rate than where the current rate environment is today, right? And so that's one of the things that you could kind of push for as well with that thinking is that, and again, it's not a thinking I've ever pushed, is that if they are wrong, well, it could be that rates are even higher. And so you benefited by getting something lower than what the rate environment went to. And then, there's also parts that people want to look out to about like, home prices usually go up, but not always. So if you're kind of in that thinking of marry the house, date the rate, you could potentially find yourself in a set of circumstances like some homeowners in Austin right now, where you might not be eligible to do the refi because the home's value has shifted down so much. I think the big thing there is, when committing to a monthly loan payment, borrowers might want to consider and be prepared for the possibility they'll be making that payment for the entire loan duration. And if they do manage to refi in the future, it would be more like a welcomed financial benefit.
Yes. You get what you get, right? The numbers have to make sense with what you've got. You get lucky if rates go down again, but I wouldn't expect it. They will eventually, but a lot of this, what you said earlier with the job market being so strong and the recession not hitting that was expected, which is what people were expecting, and that why they thought rates would go down. Do you think that it has something to do with the fact that there was over $20 trillion created during the COVID, whole pandemic era globally? I mean, that's a whole lot of money circulating that wasn't there before. It just seems like it takes a while for it to land.
Yeah, a few thoughts there, which is I wouldn't necessarily describe the labor market as necessarily like strong or overheated, kind of like it was in 2021,
Right.
but I will describe it as resilient. And so
Resilient.
there is definitely some softness there, right? Like if you are somebody who is switching, just like in the housing market, the cost for switching are very high right now for the housing. There's a little bit of a similarity with the job market, right? Where it's not exactly the best time to go find something else, right? And if you
Mhm.
find yourself losing that job in some industries in particular, it can be a little harder to kind of do the switch, right? Because a lot of employers are kind of holding on to the staff they have and not necessarily expanding a lot, right? And so I think that's one thing to point out with the job market is I would kind of describe it as more resiliency, all things considered, than necessarily overheated or strong. And to go back to your question of why is it that the labor market has not weakened more? Well, a few different theories. And I think one is kind of what you pointed to, which is we had a very high amount of fiscal intervention, right, and monetary intervention into an economy that then was supply constrained and had a negative supply shock, which is COVID-19 lockdowns, right? Production got behind. And then what we did is we accelerated demand into an environment where supply was constrained, right? And so
Right.
not meet up to the demand, and we overheated for prices, saw an inflationary shock. But in terms of like the overall resiliency in the economy, I think a part of it is just the dynamics that we went through, and we were able to see a bit of demand come down as the Fed, went into its interest rate hiking cycle, and then we saw some of the supply begin to catch up. And so as you ease that dynamic in the economy, inflation decelerated, still moving up, but decelerated. And so that put us in a position where the Fed didn't have to get even more aggressive, right? Because that's a scenario where, well, you're probably then going into a recession, right?
Yeah, right.
And at least had the success they've had on the inflation front. So that's one. Another part is probably, how much intervention was done, and that kind of
Mhm.
still through the economy. And
Yeah.
then another part is just the resiliency that we have seen from residential construction builders achieved very high profit margins, the highest ever during the pandemic housing boom, right? They had essentially full pricing control, and they were able to, you know, just achieve huge margins. And so once mortgage rates went up a lot, the affordability environment shifted, home housing demand came down, right, especially relative from those pandemic highs, builders were able to take some of that huge margins and deploy it on affordability adjustments like mortgage rate buydowns, bigger incentives, and they were able to go out and find the environment. And so what they did is they had a correction on pricing, net effective pricing, and then also on margins instead of having the correction on actual production, actual number of homes they were building. And so we've seen a great deal of resiliency from residential construction relative to past rate hiking cycles, in part because of that dynamic. And right now, if you Google it, residential construction employment, we're still hovering around cycle highs, and usually that rolls over usually 12 months or more before an economic downturn. So I think some of those different dynamics together have worked to, create some resiliency in the economy.
Yeah, that makes sense. And of course, everything did get a little wonky from shutting the world down for a year. So, looking ahead, are we finding stability? What do you see for the spring home buying season? It's usually when most people are looking to buy. Everything's been wonky, everything's sort of changed over the past few years. So, what do you see for the spring buying season?
Yeah, in a lot of ways, I expect the 2025 spring selling season and then the spring season to look a lot like the 2024 one,
Hmm.
which is a very constrained environment in terms of reduced levels of churn in the market. There's just not a lot of people who are selling their home and going to buy something else. That particular type of buyer and seller has kind of been pulled off of the market. There's still some of them there, right? And when they do, often they have a little bit less of a lock in effect because they have so much equity or they don't even have a mortgage that they sell the house and then they just buy it all cash the next house. That's the way to get out of the lock in effect, right? Is if you don't
Hmm.
have that, give up that 3 or 4% rate and take on the 6 or 7, and you can just buy it all cash. That's one way. So I expect not a ton of new listings in terms of new product coming onto the market from the existing market. I expect constrained levels of existing home sales. But I do think in a number of markets, buyers have a little bit more leverage than they've had the past couple of years. And the reason is the longer we've stayed in this environment, we've slowly seen active inventory for sale inch up. Now, active inventory for sale has not increased because there's a lot of uh, existing homes coming on the market for sale, but it's increased because homes that are for sale are having a little harder time selling, and as they have a harder time selling and they begin to, roll over into the next month, you slowly start to build that active inventory. So I think in some markets that were previously in sellers markets, some of them are not as strong sellers markets. Some of the sellers markets are now balanced markets. And then there are even some balanced markets that have kind of went to buyers markets, some pockets of San Antonio, Tampa, Jacksonville, Austin, Punta Gorda, Cape Coral, some of those places, buyers and investors have seen, more power in their hands. And a part of that is, of course, the suppressed affordability. But the other side of it is a reversal of some of the pandemic effects. And so while Florida and Texas are still seeing, population gains and are still seeing people move there, it's a lot less than it was during the pandemic. During the pandemic in 2022, from summer 21 to summer 22, Texas had about 400,000 people on a net basis move to Texas, right? The past 12 months, that was 80,000. So still positive, but it's not the 400,000. And so as you see less of, those deeper pocketed buyers or affluent buyers moving into those markets, and so then those markets have to rely more on local incomes to support prices. And in those markets, prices went up a lot more than a lot of the other parts of the country
Right.
during the pandemic boom.
Mhm.
And so it creates more of an acute affordability strain. And so homes take even more time to sell. And so that active inventory builds and the buyers gain some power there. And, there are also other factors like the fact that those markets in the South are a lot more supply elastic. They have a lot more construction. That construction comes into the market because builders had already had it in the pipeline. Builders had to do more affordability adjustments to meet it to the market. And because buyers in those markets have a lot more options from, discounted or incentives on the new construction side, some of the buyers that otherwise in Tampa or Austin or Jacksonville that would have bought an existing home are like, you know what? This existing home seller is not working with me. I'm going to buy from the home builder. And so the existing inventory then begins to build more because some of their buyers have been pulled to the new home market. And so we're seeing some of those dynamics as well. The Midwest, the Northeast, especially the smaller markets, more affordable ones in those parts of the country, they're still fairly tight. They haven't seen active inventory come up as much. They're still well below pre-pandemic levels for active inventory for sale. And so I expect those markets to be tighter, and I expect them to see more pricing momentum upwards in the spring. So I expect,
Specifically, which markets?
I would say places like Syracuse, Rochester,
Mhm.
Allentown, the deep exurbs of Chicago, exurbs of Milwaukee, or areas surrounding Detroit. I mean, really, a good number of these smaller markets in Wisconsin, Illinois, Ohio, Michigan, upstate New York, Pennsylvania, the deep, deep exurbs of New York and New York City into parts of New Jersey and Connecticut, deep, deep exurbs of Boston, deep, deep, deep exurbs of Washington, D.C. Those are places that are still tight. And it looks like they'll have upward pricing momentum. And one of the factors there is with work from home, we've seen it go from less of like 5 days a week, and we've seen it go to more of like 1, 2, 3 days a week. And so what you've seen is a lot less of like the pandemic buyer where somebody's in New York City or San Francisco and they're like, you know what? I'm going to Austin. I'm going to Boise. And instead you've seen it more of like, okay, I work and live in New York City. I have to go into the office at least 1 to 2 days a week, but it's no longer the 5. So instead, what I'm going to go do is I'm going to go find a place that is slightly affordable for me. And I would have never wanted to do a 5-day commute from that area, but I can manage it 1 or 2 days a week.
Yeah.
And so that's why you've kind of seen a heating up of those deep exurbs that's lasted even as you've seen some of that pullback into the office.
Yeah,
And
absolutely. That's what our teams at Real Wealth are finding too, that you'll see the headline news of Tampa, being too expensive and you're seeing a slowdown there, but you just have to go out a bit into commuting distance. And so, yeah, we've seen a lot of demand there. Okay, well, Lance, we are out of time. There are so many questions I didn't get to ask you, so we're just going to have you back another time.
awesome. Love to do it anytime. Appreciate it.
Okay. All right. Well, thank you so much for being here on the Real Wealth Show.
If you'd like to become job optional with rental property income, join Real Wealth for free and log into the website. As a member, you have access to the investor portal, where you can view sample property proformas and connect with our network of resources, including experienced investment counselors, property teams nationwide, lenders, 1031 exchange facilitators, attorneys, CPAs, and more. To join, go to realwealthshow.com.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.